How does liquidation work in crypto, exchange, lending, and borrowing? Imagine you're borrowing cryptocurrency to unlock funds for trading or other needs. You put up some of your digital assets as collateral to secure the loan. Now, if the value of that collateral drops too much, what happens? That's where liquidation comes into play. In crypto lending and borrowing, liquidation happens when the value of your collateral falls below a certain level called the liquidation threshold. This threshold is set to protect lenders from losing money if the borrower can't repay the loan. Usually, borrowers pledge more collateral than the loan amount, often between 50% to 70% of the collateral's value. This is called over-collateralization. If the market price of your collateral drops, raising your loan-to-value ratio beyond the platform's limit, the system automatically triggers liquidation. This means some or all of your collateral is sold to cover the outstanding loan, including any interest or fees. The goal is to prevent the lender from losing money if the borrower defaults or if the collateral keeps declining in value. Centralized exchanges handle liquidation through their internal systems. They monitor your collateral and notify you if your loan approaches the liquidation point. You might be asked to add more collateral or repay part of the loan. If you don't act quickly, the platform will automatically sell your collateral, often charging a liquidation fee or penalty. These fees vary but are meant to cover the costs of the sale and risk management. Decentralized exchanges and lending protocols use smart contracts to automate this process. These smart contracts continuously check the value of your collateral on the blockchain. When the collateral value drops below the set threshold, the smart contract triggers a liquidation event. This could involve auctioning the collateral to the highest bidder or selling it directly to other users. Fees in decentralized systems include gas costs for executing transactions and sometimes a liquidation penalty built into the smart contract. Order types related to liquidation include margin calls, which notify you to add more collateral before liquidation happens. There are also stop-loss or liquidation orders that automatically sell collateral when certain price points are reached. In decentralized finance, auction orders are common, where your collateral is sold to the highest bidder during liquidation. People use crypto loans to access liquidity without selling their assets, and lenders earn interest on their funds. Liquidation keeps the lending system safe by making sure loans are backed by enough collateral. When the collateral value drops too low, the system automatically sells some or all of it to cover the loan. Centralized exchanges handle this process internally, charging fees for the service, while decentralized platforms relying on smart contracts to do the same, with fees including gas costs and penalties. Each method has specific order types to manage these events smoothly.